Welcome to the Organized Expat, brought to you by Tytle, the platform for expat taxes. Hi everybody, welcome back to the show. Today it's going to be tax simulation day again. And as you might know, we do that in two different ways. So the first one is that we look at one profile, let's say employment income at 36,000 euros a year. And then we look at 5 countries, Southern European countries we're taking for this series. And we look at the tax burden for this person, for this profile. And sometimes we do it the other way around. We look at one country, and then we look at 5 different profiles and how they are taxed. So today we're going to look at a profile, which is employment income at 36,000, and we're going to compare 5 Southern European countries. I'm doing that together with Laurens, as always. Hi, Laurens.
Hi,
and Laurens is the tax and expat tax expert. And as always, I struggle to pronounce that correctly, expat tax. But 5 countries, which are Portugal, Spain, Italy, Greece, and France, and one profile. That's the setup for today.
Exactly.
Okay. And the employment income at 36,000 euros is the profile we're talking about. 5 countries, we just mentioned them.
Yep.
So the floor is yours. Laurens,
Right.
where to start?
Right, so we're keeping it simple, I guess. So we'll just assume that you live and work in the same country.
Yeah.
Because, of course, you could also have a foreign employer or something like that, and then the taxes can be slightly different. I mean, if you live and work in the same country, it should always be the same, no matter if your employer is abroad or not. But of course, if you have a foreign employer and you also work a portion of the year abroad, then the taxes can be different because you also have to declare your taxes abroad. But let's just check the following scenarios.
And that's maybe a side note or an assumption before we start, but it's also an interesting one.
Yeah.
Because many people ask us, so how does it work? If you work part of the year in another country, very often, or often it can be the case that you're going to pay in both countries.
Yeah, exactly. I mean, it depends a little bit on where your employer is located, or if you're working at what they call a permanent establishment, so a fixed an office, like a fixed place of working in one of the countries. And how many days exactly you work there. So you'll have to assume that if your employer is located abroad, that in that case, if you also work physically in that country for, let's say, 2 months of the year, then you're going to pay 2/12 in that country and the rest in your country of where you live. If you're living and working in Portugal for a Portuguese company, then in principle, you can assume that you're going to pay everything in Portugal unless you spend more than 6 months working in another country.
Yeah. So sometimes it can really be important to count the number of days that you're spending in that country, because that decides, let's say, the portion of the tax burden that's in that country.
And that mostly in practice becomes relevant if your employer is also, if you have a foreign employer.
Yeah.
Because otherwise, most of the times people will work 6 months in the country where they live as well.
So there should be enough, let's say, elements that tie you to that other country. So staying there, having an employer there, and if that all adds up and comes together, then it can be that you, for those days that you're spending in that other country, that you also have to pay taxes in that country.
Yeah, exactly. And I think in practice, it's mostly what you see is that if someone works for, let's say, a Swedish employer and they have to go there 2 months a year to work on site, then you enter this cross-border situation where we mostly recommend having both cross-border accountants that we have to manage and coordinate that situation, because they can become a bit tricky.
Yeah. Okay. And that's also good to know. People listening to this show sometimes ask us, so tell a little bit more about Tytle. We'll do that in another podcast, but maybe it's good to quickly mention that cross-border situations is what we like a lot. So many people approach us when they go to a different country and they need somebody there, but also when they need, let's say, cooperation, collaboration between two countries, because we have our people in both countries, and that then ensures a smooth collaboration. Okay, so first country, we're assuming that you're working in Portugal for a Portuguese employer and you're making 36,000 euros a year. What are you going to take home?
Around 23,000.
Which is not a lot.
Which is not a lot indeed. Because Portugal has a lot of tax brackets, like 8 or 9. And the percentage goes up quite fast, quite steeply. And then, of course, you have to pay 11% social security. So Portugal is, for regular employment income, is not necessarily our favorite. So we'll be 22 to 23,000. And then Portugal used to have an expat regime, which they don't have at the moment, which made them maybe our number one even. But they had the NHR regime that they stopped 1st of January.
For people new to Portugal, to attract talent, they had this regime. This regime is now almost completely abolished, except for people working in academia, researchers. Okay.
And that basically meant 20% flat tax if you qualified for your employment income. So that was a very good deal. The current one, not as much, I would say.
No, because you go up very quickly from a low tax bracket to a high tax bracket. You don't have to make millions in order to go to the highest tax bracket. You will do that quite quickly. So that's why you end up taking home only 20,000 euros if you make 36,000. Next country, close to Portugal, bordering Portugal, its bigger brother, although they don't like to put it that way themselves, probably. Spain. What happens in Spain if you...
In Spain, for this income profile, 36,000, you would take home between 24 and 25,000. So they also have progressive tax rates ranging from 19 to 47%. And a 6% social security contribution. So that's a bit lower than in Portugal, but often between countries you see that the higher the taxes, the lower the social security contribution, and vice versa. Spain for regular employment income without any type of expat regime is quite okay, I would say, when compared to other Southern European countries.
And probably the fact that social security is relatively low, that helps a lot.
It helps a lot as well. It also means that if you're retired in Spain, that your advantage is not as big, because basically the part that you save in social security is only 6% for employees. Then, of course, for expats, they do have something, the Beckham law, named after David Beckham, which basically gives you a 24...
football player, for people who don't know, Laurens is an expert in football. So for him, it's probably unthinkable that a person wouldn't know who David Beckham is. And I think maybe for everybody that would be unthinkable. But it was because of him that this rule, I think, was introduced.
Yeah, exactly. So there was a 24% flat tax. And then there are some conditions, so you need to be directly recruited from abroad, as they say it. Maybe show some proof of that. Spain for this income level is quite decent. So for the standard tax rates, it's among the high. The net pay will be among the highest in Southern Europe, and they do have an expat tax regime of 24%. Which makes them reasonably attractive, I would say.
So it doesn't really matter whether you're looking at it from, let's say, the regular standard view, just a Spaniard paying taxes on employment income in Spain for a Spanish employer, or from an expat point of view. In both cases, the tax burden is relatively low in Spain in this case.
Yeah, as in relatively indeed. And of course, I think if you qualify for the Beckham rule, your net pay will be higher. But at this income level of 36K, the differences are not staggering.
Tremendous,
so let's say if you earn 100K a year, then those are the income levels where you really start feeling the advantages of the Beckham law.
And by the way, maybe I should take back what I said about Portugal, that it's that it's not much that you take home with 22,000, because if we're saying that Spain is much better with 24, 25,000, it's indeed better, but it's also not a huge difference.
Exactly, and I mean sometimes these net pays can be a bit different depending on some allowances, etc. So yeah, relatively speaking, Spain is a bit better than Portugal. That's true.
Yeah. Okay. Next country, Italy.
Yeah.
What about Italy? Italy is one of the favorite countries. Recently, after Portugal dropped its expat regime and HR regime, we see a lot of interest in Italy, and for good reasons, I think.
Yeah, exactly. So Italy, has quite a simple tax system, just three brackets, 23, 35, and 43%, and 9% social security contribution. So we calculated the net pay to be around 24K, so a bit higher than Portugal, probably a bit lower than Spain for the regular Italian working in Italy without any expat regime. However, for expats, there is a tax break, the impatriate regime, as they call it. 50 to 60% of your taxable income of that 36,000 is then exempt.
Yeah.
So you would only pay taxes over 18,000 or 40% of 36,000.
So that's really something to emphasize here, that there's a big difference in Italy between being a regular Italian in Italy working for an Italian employer, or whether you're a newcomer, you're fresh to Italy, you apply for this impatriate regime, and that's both for Italians who left Italy for a few years and come back, and for people who are completely fresh to Italy.
Exactly. I think you need to not have been an Italian tax resident for the past 3 tax seasons before joining again.
So then you're a newcomer again.
Then you're a newcomer, exactly. And I mean, the tax breaks used to be even higher, 70 to 90%.
Which is insane.
Which is very high. And then the 90% was for the south of Italy. So now they simplified it a little bit, and they added some restrictions. So not everyone can enjoy these 50 to 60% tax breaks. So you need to show, for example, that you've had 3+ years in higher education, some other requirements, etc.
Those are the new requirements.
Yeah, and in general, the tax break is not as high. So it's not 70 to 90, it's 50 to 60, and there's no north-south distinction anymore.
Yeah. So they used to have this regime only for the south. If you go to the south, if you're going to Milan or other cities that don't need expats or newcomers as much as the southern cities or villages, because that's sometimes also important, whether you're going to a town with more or fewer than 20,000 people living there, for pensioners. But now it's throughout Italy, you can apply for this impatriate regime, giving you a huge tax break, going from 50 to 60%. So that's the first deduction. And then you start calculating the tax on what's left after that first deduction.
Exactly. And I think without spoiling the outcome already, that makes Italy probably our favorite for this. I am actually spoiling the outcome. That makes Italy our favorite.
This is also very hard to beat, I think.
Well, I mean, the next country is Greece, and they also do have something like that, something similar. 50% tax breaks for expats with some similar requirements. However, I mean, in Greece, the social security contribution is a bit higher. So that's 16%. And by the way, even with these expat regimes, you always pay social security as well in that country, unless you paid in another country under some kind of bilateral agreement. But let's assume that you pay it there as well. So you always need to pay that social security there too. And clients sometimes overlook that because they think, it's just a 50% tax break, that's it. But there's always the social security.
It can make a huge difference.
Which makes a huge difference, especially for freelancers. Now we're talking about salaried employees.
So now we jumped from the expat regime in Italy to the expat regime in Greece, and rightly so, because it's almost as good, 50%. It's not 60%, which you can claim in certain cases in Italy, but still it's good. But Greece, if you look at just regular Greeks working in Greece for a Greek employer, no expat regime, then what you take home is, because of the high social security rates there, is only
23,000. So it's
which is not only, it's in line with the average. Yeah,
exactly.
But it's on the lower end of this average.
Yeah, no, that's true. And then the last country is France. So for regular French people working in France, no expats, nothing. Then the tax rates go up to 45%, but the social security is quite high there. So for employees, around 22%.
Which is very high. So it's more than twice what you pay in social security in Italy, where it's 9%, and here it's 22%.
Exactly, yeah. So then the net pay for that income profile would be 24,000 approximately.
Which means that you're in a low tax bracket, because otherwise this outcome couldn't be that high.
Yeah, exactly. That's true.
So, but in the end, you take home 23 to 24.
It's a bit like Italy, the middle ground.
Yeah, exactly.
And then for expats, they do have a 30% tax break, but it's quite complex, quite hard to qualify for it. So you need to be, again, directly recruited from abroad, but it's a bit more strict than, for example, in Spain or in other countries. So they're not necessarily known for their great expat regime. You can say maybe it's similar to what the Netherlands have. The Netherlands is not a part of this podcast, but we also used to have a 30%.
But they have great wine and great cheese, and they have France. Paris, so they have other things.
So maybe I should not promote the Netherlands too much. And
sorry, I was talking about France.
No, I know. So I said I should not promote the Netherlands too much.
But the Netherlands also has great cheese, not so much great wine.
No, exactly.
But they're starting with it in the south, I think, with wine. Okay, so the conclusion would be that I think, looking at the regular tax treatment, Spain stands out. That's the winner.
Yeah, and slightly. But probably at this lower income level, then Spain for regular taxes is probably the best.
It's not a big difference.
It's not a big difference
that we see between the countries.
For expats, that Italy and Greece are really favorable, with Italy being just a clear winner, also because I think in both countries you can actually combine it with other expat regimes as well. I would say Spain indeed for normal income, Italy for expat income. Yeah.
Okay, that's very clear. Thanks for this summary, for this tax simulation. And I think that's also the end of the show. Again, any comments or questions are always welcome. And if you need tax help yourself, or if there's anything else you would like to discuss with us, then please reach out. Feel free to do so. And of course, you're also very welcome to listen to our next podcast. And I hope to see you there again. Bye-bye.